Barry, I don't know if the market stole your thunder a little bit. If we talked to you yesterday, would you have said, get in and buy here, and now, here we go?
Well, I think you're still fine putting money to work here. So the way I frame this out, and you and I were debating this last fall when I was looking for a 10 to 12% correction, and we were arguing, well, is the taper already priced or not? And here's how I've come at this. I've looked and analyzed every business cycle since World War II and the period after the global financial crisis, which is decidedly different. So in every business cycle since World War II, you had one Fed policy normalization related correction. It came at the point when the Fed gained enough confidence that they could start normalizing policy, right? Raising rates or whatever their policy tool was. Those were generally worth 8% on the S&P, subject to a little bit of a standard deviation. After the global financial crisis, we had 8 of those policy shocks. The end of QE1, QE2, Operation Twist, QE3, the taper tantrum, the end of the taper, zero interest rate policy, and then the 2 shocks during 18 when they were contracting the balance sheet. Market average decline was 11%, so larger because of their involvement in the mortgage market, because of their involvement in the treasury market, and just broader interventions in the capital markets. That was my expectation, was we would have one given how hawkish the pivot was. And then when you try and really hone in on that and say, okay, is enough enough? Being an old derivative guy, I look at things like the level of the VIX, the term structure. Is the front month future trading at a big premium to the 6-month future? All those things occurred in spades. My measures of volatility were 3 standard deviations above their long-term mean. That's just a way of saying that sentiment had gotten extreme.
Yeah.
And this was an appropriate size adjustment to a hawkish pivot from the Fed.
And let me restate what and I remember, Barry, when you came on and the market was at a highs and you said, and I was like, why wouldn't we be pricing this in a right? You were like, nope, wait until this is actually starting to happen and the market will correct. You've been 100% right on that. So what happens next? Have we reached the end of this correction?
We've made an appropriate size adjustment. So you were talking to my old colleague, Steve Kim, the other day, and he was telling you what had happened to home builders. Mortgage spreads to treasuries to swaps have moved out decidedly this month. Fixed income volatility's moved up a lot this month. The Fed is likely to start contracting their balance sheet in May. I doubt that Powell can say anything tomorrow more surprising than the capitulation of the doves over the last few weeks. Brainerd, Daly, Evans, Kashkari, all falling in line and saying, whoa, we really missed the boat on inflation. We need to get decidedly more hawkish. So this, to me, looks like an appropriate adjustment. Typically, what would happen is the market would rebound, almost take back most of those losses, and then be stuck in a range for a period of time, maybe a quarter or two, as we go through this adjustment to a different monetary policy regime. That makes perfect sense that, given this change in liquidity profile that's occurred relative to last year, that we would have a more difficult environment, but it's not going to be enough to really change the trajectory of economic growth. And Steve's sector is a great case in point.